Well, greetings. It's another Thursday late morning on the East Coast of the United States here in Atlanta, Georgia. I'm Professor Tamer Çavuşgil. I have the pleasure of welcoming you once again to our webinar series addressing the needs of international business educators. And today we have a much needed discussion around integrating finance into our teaching of IB courses. But let me just welcome everybody who has come back again. If you are a first-time participant in our webinar series, just know that this webinar series is offered to you by the MSI Consortium of CIBERs. CIBERs are centers of excellence in international business education and research, and 9 other CIBERs join us in organizing and hosting these informative seminars around international business pedagogy, research, and practice. We have been running these webinars since April 2020, over 70 webinars now. For your information, these webinars are recorded. Most of them are 60 minutes long, and they're available to you for you to go back and review it or share it with your colleagues on our YouTube channel, Georgia State University CIBER's YouTube channel, as well as on our own website, Georgia State University CIBER website. When you exit, there will be a short survey, just 5 questions that will come in an email. Please respond to those. They are important for us. We appreciate your feedback, your encouraging words, and also suggestions for future webinars. Everyone except the panelists is muted in the webinar, so please use the Q&A for your comments and questions, and we very much appreciate those. Drop them into a Q&A function as you think about them. And if you have a question for our talented staff, please use the chat room for that. There will be enough time for discussion today, so we do encourage comments and questions. So let me get to this long overdue topic. We have with us today a master teacher, and I know many of you joining us are dedicated educators also. Professor Hakan Saraoğlu, who's going to start this, what I think will be a series of discussions, series of webinars on integrating the finance knowledge into teaching of IB, whether we're teaching at the introductory level or more specialized courses. So the theme is about integrating the role of finance in teaching global business management. And Hakan, who is obviously an experienced and seasoned international business educators with many accolades, will share with us their experience in developing and implementing an integrated course that brings in colleagues from multiple functional areas, and also that utilizes a simulation, a business strategy game. He will introduce a couple of major frameworks. We all need these organizing frameworks to be able to connect with our students and to have a lasting impression on them. So we're looking forward to, Hakan, your discussion of the corporate strategy, operating strategy, and financial strategy, how those 3 are related: corporate strategy, operating strategy, and financial strategy. And then the free cash flow discussion as an indicator of the operating performance of the firm, and also your experience with your colleagues and students using this business strategy simulation. Just a brief background, Hakan comes to us from Bryant University, where he is a full professor. He has degrees from his PhD is from Michigan State University in finance, and he has MBA and undergraduate degrees from Boğaziçi University or Bosphorus University in beautiful Istanbul. And at Bryant, Hakan, you teach international financial management courses, investment courses, and you've been awarded many times Excellence in Teaching Awards, both at Bryant as well as at Michigan State University. You have many honors. I will not get to those, but some of those are listed on the website. You've been also very active in the internationalization of the curriculum, which is very interesting in the Bryant University Business School there, and served as a coordinator of the International Business Program Steering Committee as well. So with that, let me turn to you and welcome you, Hakan. And I know you'll be using some slides, which we will share with all of the participants. These will come to you as an email attachment after the webinar. So welcome, Hakan, and looking forward to this long overview discussion.
Thank you, Dr. Çavuşgil. Thank you for organizing it. Thanks to also the GSU-CIBER team, to Paula, Leanne, Michael, and your PhD students for organizing this. Good morning, or good afternoon, good evening to all participants. Thank you for joining us today. So let me start sharing my screen, and with that, we can begin our discussion. This is basically a short paragraph that describes what we will be doing in this next hour. And I highlighted two diagrams. So that's why there's a slide presentation here, because I'd like to talk about some illustrations as tools. And those are corporate strategic framework diagram and the free cash flow diagram. And so this is the flow of our webinar. I'll start with a preamble, and then I'll tell you some stories about my experiences in this topic, and then we'll end with takeaways. So preamble is two points. Most, if not all, business decisions have financial implications. And then with that in mind, then finance has an inherently integrating role in corporate strategy and operating strategy of a company. And with that in mind, when we teach strategy development, global business, we need a framework. We need structure. And in that sense, to implement the structure also, the second bullet, a simulation, an experiential setting for students is a good way. That it's a tried and a proven way for us. For example, I'll share with you. And BSG, which I will discuss, is the business simulation game, which is actually offered globally. And actually, students can compete globally while they're computing within their school. That's a good formal setting for students to manage a simulated corporation. And then the last bullet there is that I'll introduce two diagrams, as I indicated before, which will, in that experiential setting, students can use as a framework to run their company. And again, as I said, we've been using this framework with those diagrams as part of the experience for the students. So I'll share the outcomes and our experiences with you on that one very shortly. So although I put it at the end, let's begin with the takeaways again. What we want to take away from this at the end of the hour. There is a hierarchical relationship between corporate strategy, operating strategy, and financial strategy. Second one is free cash flow, a metric, a financial metric, as a very important indicator of operating performance of a firm. And that it will also have, in the diagram that I will demonstrate to you, has a way of also connecting to the first diagram, which is the corporate strategy, operating strategy, and financial strategy relationship. And then the last one, potential benefits of management simulations as experiential learning tools. So those are our takeaways. And But if you ask me, let's give us a one-word takeaway. What is this presentation can be summarized in one word? I can think of several one words, but this is what I have in mind. This is sort of what I want to frame this. This is, you can think of it as a systemic approach or look or discussion in basically the integrating role of finance in corporate strategy, international business. So let's begin with that. Systemic is our ideal keyword that we want to take away from this. And then let's begin with the stories. So first of all, I'll tell you stories framed around these three bullets. One is this webinar. Some parts of it is based on this recently published paper in Journal of Teaching International Business. My co-author, John Inge, who also teaches at Bryant. So that's, I'd like you to actually think of it as a reference to this presentation, because one more thing in this, when I say systemic, we can actually go to a part of the spectrum where we could be technical as to, I'm going to show you some numbers and flows of cash, for example, but their calculation is technical. In this paper, those technical details are given in detail. And but this discussion ideally is as a high level look. So that's my reference. If you want to go into more technical detail, that's available there. And then the second bullet, which is the experience that I'd like to share with you in putting this framework to use. We have at Bryant a nationally ranked international business program. And in that, we have a junior level experience, which we call integrated international business integrative experience, or IB block, we shortly call it. This is all required, and we have a cohort system. All the students in their junior year take that course, form teams, and run a company. And then I'll explain further. And the last one at the bottom, you can see the web address of it, an online accessed by a browser, well-run business strategy game that we've been using for many years at Bryant. So my stories will sort of be around these 3 points. Let's move on. That's, again, just to show you one more time. Slides, when they're emailed to you, will have that. Here's a short look at our IB block in the junior year. It's made up of 4 courses: international accounting, multinational finance, which I teach; international business management, more of strategic management with entry decisions and strategy setting globally; and then marketing management, international marketing. And then we combine them with the management simulation. So a pictorial look at it would be this: 4 courses simultaneously taught in a semester. We coordinate as 4 instructors, decide on the cases and all that, so that they actually serve the integrating role of this program. And in the middle is the true integrator, is the business strategy game. Throughout the semester, students run a simulated athletic shoe company for 10 years, simulated 10 years over the course of the semester. And we, the instructors, serve as the board members. We have a midterm and final formal presentation, and then the game environment allows them to set formal strategies that are reviewed actually by the game setup.
Hakan, you mentioned that these
Sure.
4 courses make up the junior year. I assume students take them, a couple in the fall, couple in the spring, but is the BSG simulation game itself tied to one of the courses, or does it run simultaneously with other courses?
I'm glad you brought it up, Hocam. Actually, those 4 courses and the simulation have to be taken simultaneously. So basically, these same semester, and these 4 courses and the simulation, which takes place outside the classes, but then we help during our classes. For example, each instructor serves as a mentor to each team. So they have to take it simultaneously. By the way, in that sense, it pretty much takes up their own one semester in the junior year, either
Good.
spring or fall semester.
Good, good.
So with that, this is some examples from the books and some cases that I use in this class, but that's going to go more to the technical end. So just I included in here some international finance books that I found ideal in my teaching. And then I gave 2 case examples that I've used over the years. And they're included there by way of their subject matters. One is, notice, is hedging currency risks, which is an important point in financial strategy. And then the other one is very important point, connecting finance to corporate strategy, which is capital budgeting, cross-border valuation, whether or not expand globally, build factories other places and all that. But let's move on. Now the BSG, the second part of the bullets that I had shown, BSG actually has 4 regions, this simulation, and basically paints a picture of the globe. And as they take over the company, they currently have a US, North American plant and Asia Pacific plant. But they can actually expand to the other 2 geographic locations. So it's a basically building a facility and then putting machines in it, kind of a decision. But then, as you noticed, there is also sophisticated shipment decisions in this, that they can ship to and from all those locations, and they have warehouses, and then they have basically selling opportunities in all these 4 regions. So
This is a global shoe company, which the students, I assume, find it relatable. I mean, they can all relate to shoe companies. Okay.
Very good point, Hocam. Exactly. And so they, in their presentations also, sometimes we require them to make short videos, and then they actually make up their own videos with like running in the track in the school and devising advertisements and things like that. So correct. So with that, notice, by the way, in these blocks, there is USD, EUR, BRL, and SGD. That means these students are also learning to operate with 4 currencies: Euro, US dollar, Brazilian real, and Singapore dollar. And the BSG setup is good that it ties it to the actual exchange rates in a mapping routine in their software, I think, so that the movement in these currencies when they're playing the game during the semester is tied dynamically to the software, so they can actually get forecasts of what may happen in the next simulation year to one of these currencies. Can they depreciate or appreciate, which is a factor that I'll shortly discuss. So anyway, let's move on. These are the decision areas. There are many decisions that are made, so that makes it very realistic. And you can, I don't have to read the list, but as you see, combined, there's all aspects of running a multinational corporation, from human resources to operations to finance, including also corporate social responsibility. And then there are sub decisions. I'm not going to again go into detail, but for example, workforce compensation may mean base salary, fringe benefits, training, supervisee ratios, all these complicated things, which makes it many moving parts, which makes it complicated, but students benefit from it at the end because they get confidence as a result of having to deal with these things. All right, now I'm going to go back up again. That's the sort of the framework for experiential learning that I want to make the case in an experiential learning setting that is facilitated through a simulated global athletic shoe company. Students will now have to run that company, but when they're running it, they have to step back and put some framework in their management of it. So in that, we found that through the teaching of this global, we actually gradually introduced this framework that I'm going to introduce to you, that we said, okay, let's put a framework, they have to step back at the beginning of their 10-year tenure in running this company. They have to actually start with a plan. And here is the first diagram that I'm going to introduce to you in this webinar, and as a framework, and that's the corporate strategic planning diagram or strategy setting diagram. And notice there's a hierarchical relationship. It starts at the top with corporate strategy, middle is operations strategy, and at the bottom is financial strategy. So we give this as a template to the students at the beginning of the semester. And we, first classes, in each of the 4 classes, we make a discussion of it, saying that, well, step back before you roll your sleeves, do something about this thing so that you have a framework of running the company. In the next couple of slides, I'm going to fill in the blanks here, but here's the deal. Notice what would count in this diagram is the arrows and is the location of finance. There is a reason why it's at the bottom or is at the last point, because as you will relate to it, it all starts with corporate strategy, starting with the identity of the firm, their mission, their vision, what they want to be. And then it trickles down. Operating strategy should be in the middle, serving it. And finance is no wonder at the bottom. And finance says this: you set the corporate strategy, make sure your operations serve it, but then we'll make sure that we'll help you doing what you need to do in operating the company. So finance is there at the bottom to serve. And with that, let's take some quick looks into this diagram. So this is something obvious where we can put now different functional areas mapping onto this. On top, there will be strategic management. In the middle, you can put all basically operating functions, including financial management. And at the bottom, financial management is there. Again, and in terms of serving the top 2. Now, let's expand further. Now the decisions. We started with the functions. We now can tell the students, map your decisions so that you're aware of what you're doing in terms of running your company. Well, again, as you will relate to this, that strategic positioning, market entry, capital budgeting is on top. Capital budgeting, that's the finances effect in serving the strategy, where, for example, their company wants to spend a lot of money building a new factory in Europe, Africa region. That's a capital budgeting decision. Before they spend all those hundreds of millions, they have to sit back, and finance should help them whether or not strategic decision of wanting to go there is financially sound also. So in that sense, that's where now we started integrating finance. That's how it serves with capital budgeting. Middle is operating decisions, all sorts of decisions from human resources to tax compliance to financial control policy decisions, like, again, making sure that the cash is there when it's needed, making sure that the cash budgeting is done, from finance to other operating decisions. At this point, quick pause. I'm introducing this to you from a junior level perspective, but if among you are professors of introductory freshman or sophomore level IB classes, we can also think of it the same way. Semester can begin with putting the big picture of where finance will relate to all the overall management of the firm. This would fit well as to telling the students, you're going to learn finance, but here's why you will learn finance. Here's what you will learn so that you can help other parts of the company. And that's why I think it's a good framework for that purpose also.
I was just thinking of that, Hakan. That's a very good point you made. I'm thinking about, let's say, if I were to sit down at the beginning of the semester and ask myself, how do I insert key financial strategy topics into my IB, introductory IB syllabus? This gives me a roadmap. I mean, so I know that with respect to supply chain or marketing or HR, whenever I discuss those issues, I have an opportunity to bring in the finance context.
Very good point, Hocam. Very good point. So in that sense, as you also affirmed, that it's not necessarily just valid for a junior level setting, more advanced setting, but at the onset, of course. So I'll spend about half a minute also at the bottom, financial strategy. Notice what I included there. It's dividend policy, whether or not to pay a dividend, whether or not increase it or keeping it steady. Shall we sell new stock to finance our operations, or shall we repurchase our stock? By the way, the BSG environment allows the companies to buy back their stock too. So capital structure policy decisions, that would mean when we need $1, shall we just finance the entire dollar with internally generated funds from our cash from profits, or shall we do 50-50 debt financing and equity financing? That's the kind of decisions. Debt management decisions, yeah, when we decide to borrow, what's the term structure of borrowing? BSG allows short-term borrowing, 1, 5, 10 year, and also it allows early payments, retiring of debt kind of decisions too, which is like more sophisticated entry into finance decision making. So debt management is there. Foreign exchange risk management decisions. This is very important, by the way. I'll shortly introduce it to you without going into detail, but as Dr. Choshko was saying, we can later go into more details if there's a follow-up, where in the BSG environment, there is not a financial market for hedging. In other words, there are not financial derivative contracts available to students, but they can do operating hedging of transaction exposure. In that sense, operating meaning they can do hedging through operations, which is more or less gives them an approximate dealing with foreign exchange risk, where they can decide on their shipment decisions or production decisions based on where the currency forecasts are. For example, if Brazilian real is forecast to be lower in value with respect to the US dollar, students can focus more on producing in a lower currency, depreciating currency environment, and then that allows them their cost to be more advantageous, for example. So that kind of a hedging through operations is available by production, location, and shipments decisions. Or for example, if they see euro on the way up, they can actually increase their advertising in Europe so that they can earn a currency that is bound to appreciate, and then they can buy more dollars. Students can actually do that in the BSG setting. And then working capital management decisions, which is one of the most important actually in finance, and especially international business, especially in exporting, for example. And then capital budgeting decisions, which is whether or not build a new factory. Anyway, so let's move on.
Hakan, if we go back to that slide, I mean, if I'm a typical IB professor, I feel very inadequate in terms of covering all these 7 financial strategy decisions in my course, introductory course or specialized course, in depth. So with the exception of foreign exchange risk management, typically we don't touch the others in our courses, partly because we don't feel adequate enough. So if I'm one of those faculty members who needs to, gear up and get some background on these topics, what do I do? I mean, what's the best way of preparing myself, developing myself, so then I can in turn impart, share this knowledge with my students? I mean, are there any quick tips there, suggestions from your experience?
Sure. One thing is, again, systemic, the word systemic applies first. And the second, those 2 books that I mentioned, they have chapters in detail dedicated to that, but there can be excerpts taken from them as a summary to apply to an introductory course, for example. But systemic meaning, what is the relevance of each one of these bullets to the overall success of this big framework is the starting point in my mind. For example, dividend policy decisions. You can just, without going into much detail in a class, mention that if you pay dividend, you have to have cash. So you have to then make a decision on whether or not you can afford to pay dividend, you can afford to increase your dividend. And before making that decision, you have to first take care of your operational needs of cash. So you can just say that's a check, so that students now relate what a dividend policy decision means, which is a cash decision, which is giving the cash that can be used to build another factory in Latin America to just pay us out as a dividend. And then you can just say, what are the pros and cons of paying a dividend? Who's my clientele? If there's a clientele effect, who would prefer dividends? Or the environment, when would it be a good environment to pay dividends? That's a check. Then stock issue repurchase decisions. Again, we can be very simple in the introductory course, and we say this: if you sell new stock, you're using the most expensive source of financing because you're diluting your existing shareholders. And by way of their function, by way of their risk taking, stockholders are the last in line. So they require the highest return to invest if they buy your stock. So that means you're getting the highest cost of capital financing. So that means we can just say, maybe try to find other ways of financing before you go to issuing new stock. Repurchase is the same thing in terms of dividend. If you want to buy back your shares, why are you doing that? Do you have cash to do that? Because repurchase decision is a cash decision. You're going to disperse cash, which you could use again to build a new factory in Brazil. So that's a check. Capital structure, again, here that financing may have its benefits because of tax deductibility of interest payments. So that you can just check saying that this is why there's such a thing as capital structure policy. And then the list goes on. I don't know if this helps, but that would be at an introductory level, very good way of putting why we're doing what we're doing in finance. And then you can zoom into detail to the extent that is appropriate.
This is excellent, excellent, Hakan. Thank you.
Sure. So now let's move on. This is I hope you will actually like this, enjoy this, and sort of relate to the earlier parts. This is an instantiation, if you will, of those previous looks at this graph or diagram, with taking some examples from our use of BSG. So some of them are even took from the reports of the students as to what they want to do. So in other words, we want them to, before they roll their sleeves and start running their company, we want specific bullet points as to what they want to do within this environment. So let's start from the top, very short. Sell affordable athletic shoes at low prices. Notice this company is wanting to position itself at the bottom where low prices, mass volume globally. And they want to be good, social, responsible corporate citizens. Then to serve that in the middle, they have to make sure that they have to have some reasonable quality. By the way, in the BSG simulation, there's some good measures of quality so that they can relate it to price and all that. Then obviously their marketing decisions, one of the P's of marketing, they have to set lower prices compared to their competitors. They have to promote their products, do some another P in marketing. Then this is not something they have to do, but they may say, we want to be a seller in all 4 geographic regions, truly global seller. And then they want to keep operating costs and expenses lower against competitors. These are some highlights as to their operating strategy pertaining to operations management, human resource management, production management, and marketing. At the bottom, notice now, this is the most important part. We discuss it actively at the onset with the students. Some students go in and by way of personal preference, they don't want to have any debt. So if they want to pay back the existing debt, or they don't want to pay any, have any debt in their company, but then we say, well, if you decide to be a globally present producer of low price shoes, you need to produce a lot of shoes, which means you need to have capacity, which means you need to spend money to buy the capacity. And that's where finance comes into serve. It says, okay, if you want to go to another region and expand your capacity and you need $100 million, we'll be there to find it for you, which is raise funds for expanding production facilities. So in other words, they're not going to say, oh, we don't want to borrow money, or we're not going to raise funds, but they also want to be a global producer of mass volume market shoes, that notice there's a mismatch. The arrows are not serving. Finance has to find that money for them. And then, which means they can use debt financing, borrow money. They could choose to use the internally generated funds, which we can call from an accounting perspective, retained earnings, and use debt financing. We talk about again, relatively cheaper source of financing because of tax benefits potentially. And then they also decide on dividends and if buyback. So notice, this is an example where if they set a corporate strategy on top, operating strategy must be commensurate with it, and finance should find the funds for making everything possible. Now, we summarize everything in the diagram with these blue points. We just say this: it's the same coin, both sides of a coin. To survive and keep operating, a firm should constantly buy assets, invest in assets, short-term or long-term assets. Example, Walmart, early hours of the morning, trucks roll in to replenish the shelves. That's Walmart is buying assets at 3 a.m. in the morning. If they don't have those trucks coming in, there will be nothing on the shelves, no assets. Walmart will not be able to continue. But that means what? When those trucks come in and Walmart is buying assets, Walmart is simultaneously financing it at the bottom, which means maybe they're using the supplier credit. Maybe they're finding other ways of finding the money to pay for those. And basically, we teach the students, if you want to operate, keep buying assets. When you're buying assets, know that that money must come from somewhere. You got to borrow money. You can use supplier financing, trade credit, or you can issue stock if you want. But those blue points are there. So anyway, that's the first diagram. We set the setting now for running a company. Now here's the crucial second diagram, which you will be saying, what is this? I deliberately left it blank. I've been using it for over 20 years. This was inspired by a simpler chart in a book that I used over 25 years ago. And then I basically turned it into this diagram. Let me explain, by the way. Let's end the intrigue here if there's any. Here's the deal. The big rectangle here, I'm going to do some, by the way, annotating here. This one is the assets of the firm. They're operating. That's why I drew this arrow. And here there's the non-operating assets of the firm. So if they have some excess cash that they parked in some short-term investments, they're not used in the operations. Operations means for this company making and selling shoes. So if there's any assets that are not serving that purpose directly, like money in the bank, very back of the envelope example, then we separate it as non-operating assets. And then notice there are these pipelines, and here the integration of finance to corporate strategy comes in another form through following the cash. Follow the cash, and then this ties back very interestingly to that previous three block diagram. Let's begin. I'm not going to spend time on this one, but I have a little bit expanded version of it. So here's the deal. I'll follow the cash. Cash comes in through revenues. And then firm has to take care of its tax payments. Obviously, firm must take care of its operating costs and expenses. Notice this is cash. We're not doing accounting profits. We're following the cash itself. And then the remaining cash wants to go to the right. It's almost like the rivers starting at high elevations and wanting and finding their ways to the sea. Notice this cash wants to flow to the right on your screen. And guess why? Because there are the sources of capital to the firm to begin with to make this firm possible in the first place. That means we started the firm by relying on the capital from these investors. So now if we generate cash through operations, it has to go to that direction. So here's the deal. You'll like this, and then I'm gonna give some simple round number examples of it in the next slide. Cash wants to go to the right. This is called operating cash. So that means if a company can generate positive number with this, that must be doing justice to its operations. So in other words, they're not making a pizza for costing $15 and trying to sell it at $5. They're not bleeding cash. They're doing justice to their operations. So now, if this number is positive, that's operating cash. Very important performance measure. But guess what the firm has to do? It has to take care of its capital expenditures. That means if its machines are all old in their Asia Pacific plant and they need to be replaced, that's major capital expenditure in cash. They have to do that. Otherwise, they cannot be in business. So that means cash, before flowing to the right, must first take care of asset requirements. Asset means continuity. Remember, this is very important that I always tell students. To survive, to continue operations, firms must constantly be acquiring assets. So that does it. This is very important. It also has to flow to change in net operating working capital. That means taking care of the operating working capital investment, which is if inventories need to be replenished, or a higher level of inventory has to be maintained, if some higher level of cash on hand is needed, or even some trade credit must be given as accounts receivable to enhance the marketing or the sales, then that has to be also invested back in cash. And so this is like the adjustment that makes this concept that I'm getting at, which is free cash flow. That means if after this there's any money left, that's a very important point, because that means what then? That it means that this money can go to investors. It can go to shareholders in the form of dividends or buying back stock. It can go to creditors for repayment of debt or paying interest. Those are the uses of free cash flow. So notice then, we're talking about a very important metric for operating performance, free cash flow. And then again, I use some numbers: 800 minus these minus 500, 200. That's the operating cash flow. The firm built some factories, put some inventories in there. 100,000 is left. That's free cash. And then during the period, that cash was dispersed, some to their debt holders, some to their credit, to their shareholders. Notice everything adds up in the system. Yes, Rajan.
Quick question. Free cash flow, if you want to express that in a proxy, in a ratio, a financial ratio, what would be commensurate? I mean, how would what ratios would I look at for a company to estimate their free cash flow?
Well, actually, free cash flow is a calculated number.
It's a ratio by itself.
It's a number by itself, exactly, which this diagram to some extent sort of pictorializes, let me define it first, and then I can also give you a formula within the form of the definition. Free cash flow is the operating cash flow, the cash flow that is generated from operations after asset purchases are taken care of. So that means it's operating cash flow minus investment in capital expenditures minus increase in net operating working capital of the firm. So that's basically the definition, and at the same time the formula. Operating cash flow, by the way, to calculate operating cash flow, we can have the left-hand side, it's almost like a formula: revenues minus taxes on operating profit minus all these costs at the bottom. So 800 minus 90 minus, I put foreign currency impact here from the technical detail of the BSG simulation, minus 500. So that's from a formula perspective, revenues minus these out arrows, that gives you the operating cash flow.
Excellent. I see the numbers now. Thank you.
Yeah. Also, there are other formulas. I'm glad that you raised it as a question, Dr. Çavuşgil, that in that paper, there is actually all the model of converting the balance sheet, income statement, and other information to this diagram with all the formulas explained as exhibits. And also there are, again, in textbooks, those formulas, expanded descriptions of them. So we can find it that way. So one more thing, by the way, let me just for those who to connect it to the accounting, that you have operating profits that you can calculate from the income statement of a firm. Just like follow the income statement, operating profit, which is revenues minus costs and expenses. And then you can adjust it for taxes on operations, which is net operating profit after taxes. If you add back depreciation to that, that will also give the operating cash flow. But it basically, to the simple formula that I explained, they come to the same conclusion. So just for those who want to relate it to the calculation of this number from the income statement. Net operating profit, add back depreciation. So now, this is the ideal picture, which I explained, of a company where notice bold on the arrow coming in, because very important, revenues drive everything. So I want to actually go back to the numbers and then start, because I jumped ahead, I think, in the process. Yep. All right, so I collected I was pressing on the wrong arrow. Okay, so notice it's the bold arrow. That's where everything starts. And then here we use this term. Now I'm going back to the integrating of the finance function. So we use this at the beginning of the semester to tell the students, know your lay of the land in this perspective, where what are the stakeholders, where they lie in this cash flow picture. Notice governments are here, and then suppliers, workers are at the bottom, customers up here, and then bondholders, banks, other lenders, the creditors are here, and the shareholders are here. So one aspect in an earlier class, also in an IB class, this can be used, where the students can be introduced to the lay of the land. Then you can tell the students, again, this is an introductory IB point, going back to our earlier discussion, we can map those operating activities and different functional areas of the business on the 3-block diagram to this one also. Notice that here is the marketing management, strategic management, dealing with the FX market, financial management, dealing with tax is accounting, then all the operations management points, production management, human resources management there. Building new plants, capital expenditures, like spending hundreds of millions to build another shoe factory in Asia Pacific. That would be strategy decision, but also capital budgeting decision, financial management. How much money to park in non-operating assets? Should we just park some of our money and not invest in long-term investments for a while? That's a financial management decision. To decide on working capital management, how much inventory should we use? Which is, it has to communicate with operations management, supply chain management, and financial management, so that we don't hoard inventory, which is hoarding capital that is on low return investment. And then obviously dealing with the investors in the financial management. Notice financial management, integrating role in this picture. One more step. What kind of decisions we tell the students? Just like that 3-block diagram coming into this, which is all the decision that we talked about before falling into the place. So with that, it's shaping up now. Those two diagrams are basically combined into the framework. Now the students say, we're going to run our company and assess our performance and report our performance with the framework in mind. So that's why we asked the students in their presentations to give us every year's results in this diagram, which I will quickly show in this case. This is an ideal example. Again, they started out with 800 of revenues. After the costs and the taxes are paid in cash, they had operating cash flow of 200. They decided to take on a major expansion in, let's say, Latin America, and they put some working capital in inventories there. They had a negative 50,000 free cash flow, 50 million, we can say. Notice what's going to happen here. How was this possible? They earned 200,000 cash from operations, but they spent 250 in expansion. So they were actually having a negative free cash flow. This is the beauty of this diagram, because it says that, notice, no cash is lost in the system. If this was negative 50, negative 60 plus positive 10 is negative 50. So everything is preserved. And here's the explanation that the students tell us. This year, they say, we earned good operating free cash flow, but we made a major expansion, which made our free cash flow negative, which we financed with additional debt. Notice negative sign, that comes from the debt holders. So here, 60 came in from the debt holders. It's financed the remainder of the expansion plan, and some cash was still used to actually maintain the dividend that they were paying. This is very important because this says that dividend is paid in cash. So it's not like the accounting profits and the dividend that we want to connect. Dividend cash can come from anywhere. Cash is cash. And this is a great example of that. Cash was also supported by some borrowing in that. So we're coming to the end, by the way. I just want to wrap up, but this is another case, an ideal case. I put some non-operating flows, which is company may have earned some interest, which is non-operating cash that supports the cash position. They may have had some hoarding of assets. Negative 20 means they may have used some of the cash. Hoarding of assets meaning they may have some unused cash, excess cash, in a short-term investment, let's say. They may have released it. So notice 200 operating cash, they invested in their assets, there's still 50, 20 coming from releasing some excess cash, 70. They earned some investment return from that excess cash, 75. And now they can actually, during the year, they distribute it by paying back some debt, paying interest, or also buying back stock or paying dividends. So I'm going to stop here. I put some, by the way, stories that will enhance our discussion. But it basically, if I fast forward it, it's going to go back to the takeaways, and that's the end of our discussion. But I want to make sure that.
So Hakan, let me going back to the cash flow diagram,
Sure.
Your second diagram. Of course, you're reminded the students, well, okay, we have now 3 other currencies plus the US dollar. So, and you talked about the simulation actually using real time exchange rates. So that capital expenditure you made in Latin America, 225, whatever it was, or 75, let's say, in this case, may end up less or more, right, in US dollars. So how do you bring that discussion, that multi exchange rate discussion, and keep it in the back of their mind so it's not forgotten?
Very good point, Hojam. Actually, in addition to just keeping in their mind, we actually make a deliberate effort to make it an active part of their decision-making process, which means operationally try to maintain their FX exposure. Here, they have transaction exposure to foreign exchange risk, which means they sell the products and then their payments are going to be down the road, or they produce a certain thing and payment to suppliers will be some down the road. So if during that period unexpected negative changes happen, they're facing a risk. So we maintain them at alert all the time so that they can think of it. Plus, of course, your point about making expenditures. So here's the answer, Hojam. First of all the income statement, balance sheet, and cash flow statements that BSG provides at the end of each simulated year is in dollars. So they convert it to dollars so students get the results in their operating currency. However, there is this point as foreign currency impact that is given to them, which is basically BSG Simulation's way of telling them if they had a negative impact during the year from foreign currency or positive impact. Let me give some specific examples, short and concise. For example, they may have had some transaction sales in euro. By the time they collect that, if euro depreciated, it counts toward them as a negative FX impact. And that shows as a negative impact on their revenues as given to them as BSG, which we include in this diagram as a negative impact on their cash. Because if euro depreciated and they build their sales in euros, by the time they collect it, they are actually getting low conversion to US dollars. So that's the depreciation impact, negative impact on their revenues. So that's how we introduce it to them. And then that's what we say, for example, if you see a currency on the way down, you can try to produce in that region so that you're producing at a currency that is costing less in US dollars so that your production costs will be affected positively. Or if you're seeing a currency on the way down, but there is a Latin American region where its currency is on the way up, maybe transfer some advertising dollars to Latin America so that you can earn more sales in an appreciating currency. So that's, I don't know if it answers your question, but this is operating hedging of those exposures.
Excellent, excellent. In fact, your last comment, there was a question on transfer pricing from one of our participants. How does transfer pricing figure into this, what you're discussing? In fact, you just gave an example. So maybe buy-in from your Latin American plant, supplying, let's say, European customers from your Latin American plant rather than the US plant, because the more favorable exchange rate, something like that. So you keep that, I'm sure, again, you bring it up, those transfer pricing strategies to the attention of the students.
Exactly, and to the point of their attention that they actually learn through the 10 years of their tenure running the company, or how to deal with that. And in the final presentations, it's great to hear comments like, we were seeing, for example, Singapore dollar on its way up, so we focused our sales efforts on Singapore more, or we saw euro depreciating, so we tried to produce more in our euro region and then ship from that region to a place where its exchange rate impact is positive. The beauty of it is that BSG gives all the forecasts for the next simulated year of the directions of all currency pairs. It says what's going to happen to euro USD, Singapore dollar USD, and then it tells this is the potential impact on your revenues and your costs. So it says green, for example, if the Brazilian real is going to depreciate with respect to euro, it puts a mark on the forecast that says Brazilian real is forecast to depreciate with respect to euro, then it may make sense to produce in Brazil at the lower depreciating currency. And if you can ship to the euro plant to sell those, then there's that margin that will be gained. So BSG actually in its manual also talks extensively about that. So that
intra-corporate pricing and transfers figures into this very, very prominently.
In a very sorry,
and then give you the last word before we wrap up. But I mean, you have a wonderful way of taking complex subjects, at least they are complex to me and I think most of us, and making them very easy to understand, very rational to understand. And you have a lot of praise from our participants today. And I asked participants if we were to, and we are going to have Hakan back in a future webinar, but what topics would you like him to cover? So when you log off, you'll get that email survey. Please suggest some topics that Hakan can cover for us in the future. Bruce Kibler, one of our participants, endorsed your simulation. He says he used this simulation for years, excellent tool. He loves how you are simultaneously integrating the coursework across functions using the simulation. So there's a lot of good feedback, Hakan. And I'll give you the last word and then we'll wrap up.
Thank you. For the sake of everybody's time, valuable time, my last word will be thank you very much for listening, being part of this thing. And also at the same time though, if you have 3 minutes, I want to just go through these things very quickly, okay. which is another way of using this in the simulation that I've been doing this, tying it to Wall Street Journal, Economist, or other articles, and mapping them onto any article that may relate onto that free cash flow diagram. So here's the quick examples in 3 minutes. Okay. This is a Wall Street Journal article that says Coca-Cola was impacted negatively because of FX headwinds. So here's where it is on that diagram. So I tell students to have a blank version of this thing, and when they read the Wall Street Journal, try to draw the cash flow explanation of the news. Notice negative FX impact, which will be a bad influence on the operating performance. This is a cash dilemma, how to spend it. Again, from Wall Street Journal, that it says corporate cash piles have swelled. That means corporations are hoarding cash, putting almost like to a bank instead of building shoe factories. Well, that means money is going and adding to non-operating assets, and that money is earning some interest. So money is not being enhanced through operations, but it's coming from hoarding cash and earning some interest on it. But fat bank accounts at some companies are not something investors necessarily want to see. Growth companies that are doing this may be exiting their growth, it says. So here's the deal. If company is not using the money to buy back more shoe company assets, and it's hoarding cash, then investor, if I'm an investor, I say, well, maybe they ran out of good ideas in their business model. So see how that fits very well into the picture. And then finally, to be sure, many companies have put their cash to good use, such as paying off or refinancing debt. Others are increasing their payouts to shareholders in dividends and buying back stock. Notice, this is the finale. If they had excess cash, now they're releasing it and making, instead of sitting here, using it to pay back debt, to pay interest, to increase dividend, to buy back stock. Thank you again for listening. I look forward to your further questions. And if we do a follow-up, I look forward to that also. Thank you, everybody.
Thank you so much, Hakan. Again, you have a wonderful way of explaining complex topics for us ordinary IB faculty. So You'll stay online for those who maybe you can take a look at some of the comments and respond or questions.
Yes.
If there are some. Otherwise, we'll see you at our next webinar next week. You all have a good rest of your day. Take care. Stay in touch.